Let's go to Chicago. Vice President, Blue Line Futures, Oliver Sloup. All right, Oliver, again, pretty good week last week for the row crops. Corn up 4 straight sessions, beans up 3, and Chicago and Kansas City wheat up 2. Can they do it again this week?
Well, time will tell, but last week certainly constructive and puts the chart in a little bit more favorable territory than where we started last week's trade for sure. As you had mentioned, though, corn kind of setting back a little bit, which I guess you could make the case is healthy for the market after the run that it had in the back half of last week's trade. We're kind of at an interesting spot in terms of technicals go. 419 to 422, that's going to be a big inflection point for the market. That's the 20 and 100-day moving average and was trendline resistance before we got out above it last week. So old resistance, now going to be support to start the week so long as we can defend that pocket. I think the bulls have the advantage to the upside. The hurdle that we want to get out above, 424 3/4, that was the high last week. And if we can kind of jump over that, I think that opens the door for a retest of the gap from July that we retested a month ago, and that comes in 431 to 433. So favorable chart setup despite a little bit of weakness to start the week.
Okay, and then you mentioned that. What are we looking at when it comes to soybeans? Because, again, we look at that 6-month contract on the 6-month chart here on the November contract. This has been really choppy action.
Really choppy action. And I mean, if you zoom out, as you had mentioned, we're basically in the middle of the range, which also coincides with the 50, 100, and 200-day moving averages, all between about 1025 and 1030. So we haven't gone anywhere too fast. We've traded about 45 cents on either side of that. And this is a very headline-driven market, and seemingly the pretty equal risks of that being a bullish headline or a bearish headline, which, you know, prior to the government shutdown, we were watching the Commitment to Traders report very closely, and funds really never got in a position where they were over 50,000 contracts long or under 50,000 contracts short. So very indecisive funds, I would imagine, even though we haven't gotten any recent reports, the funds still have that same mentality right now, and I think price is telling us that just a lot of indecisiveness and waiting for more new news with regards to trade.
Yeah, we're looking at this year's November versus next year's November, and the November 26 trades at 1072. Let's look at the same thing here for corn, 420 for this December, and next December at 457.5 will be interesting as we start making decisions about our row crops for next year. Oliver, hang on for a moment. We'll come back. We'll talk about a market that's, well, speaking of choppy, man, you really had to hold on last week for that cattle market. We'll come back and talk about that. Market Day Report continues after this. It's settled, though, lower 2 straight sessions. Oliver Sloup is with Blue Line Futures. What's happening here, and what are thoughts as we go through the rest of this week?
Complex was on a chopping block on Friday. Limit down in the feeder cattle market, which gives us expanded limits for live cattle and feeder cattle today. Not sure if we're going to be able to test those or not, but they are there in place. So for live cattle, that's 1075, and for feeder cattle, that's 1375. So we expect the volatility to continue, and these wide ranges have really kind of kept people on their tippy toes, certainly with the headline risk that continues to loom over the market. And that's really what drove prices lower on Friday, was the headline risk with regards to the administration kind of wanting lower beef prices. And the administration has hinted at this for the last several weeks, almost maybe a month and a half or so. But it seems like there might be more substance behind last week's announcement. So I think the headline risk is even greater going forward. And that's why you're starting to see some pressure come into the market following a little higher open in feeder cattle this morning. So it'll be interesting to see. I think a lot of traders kind of sitting on their hands, trying to be nimble to avoid those headlines that could really kind of wipe a trader out.
So, Oliver, I'm just kind of thinking here as you describe this, we're also past the prime grilling months, if you will, the summer months. Could we start just seeing a seasonal tendency towards shifting out of beef? And could that be positive maybe for the consumer side on prices?
I think that could certainly be the case. Seasonally speaking, yes, we do start to see a downtrend in the cattle complex. I have been taking the seasonals with an extra grain of salt, and they have not really come into play at all this year in this, once in a decade bull market. But I think the headlines regarding the administration wanting lower beef prices and maybe more substance coming behind it soon is really going to continue to weigh on the market, or at least kind of keep bulls a little bit nervous here in the near term. If you're taking the opposite side of that and you want to remain bullish, that's great. But no, the government wants lower prices, so you're essentially taking the other side of that trade. And from a risk management standpoint, that's really tough to explain to investors why you're taking that position.
Yeah, good points. Oliver Sloup is with Blue Line Futures in Chicago.